Welcome to this session, Live at Wall Street, Solutions on the Financial Crisis. I'm Jongnam Oh, Professor of Seoul National University and Senior Advisor to Kim and Chang. This session will be live, video conference, participated by world-famous distinguished panel members who have worked in the financial sector and have gone through several crises. We'll get live view from Wall Street in New York, epicenter of the current financial crisis. Let me briefly introduce distinguished panel members of this session. From New York, we have Mr. James Ulfunsen, Chairman of Ulfunsen and Company LLC. He is also advisor to Citigroup's senior management on global strategy and international matters. As you may know, Mr. Ulfunsen was the 9th president of the World Bank Group from 1995 to 2005, including the Asian financial crisis period. Let's give him big hands. Mr. Ulfunsen, we welcome you.
Thank you very much.
Next person from New York is Mr. Louis Alexander, Chief Economist and Head of Economic and Market Analysis of Citigroup. Let's welcome Mr. Alexander.
Thank you.
Another economist from New York is Professor Ken Rogoff, former Chief Economist of the IMF and a former board governor of the Federal Reserve System. He is currently Professor of Economics and Public Policy at Harvard University. Professor Rogoff, we welcome you. Now we have another panel member with us here in Seoul, Mr. Jeffrey Schaefer, Vice Chairman of Global Banking City. He is also Head of Economic and Political Strategies for Citigroup. Let's give him big hands, Mr. Schaefer. I'd like to take advantage of this Live at Wall Street Solutions on the Financial Crisis. Now that we have distinguished members in New York, I'd like to begin by this question. We have seen so many ups and downs in the New York Stock Exchange. What's happening there in New York? Today, here in Korea, our stock market also experiences the same, and our exchange rate also experiences the same. Mr. Ulfunsen?
The situation is, of course, very difficult at the moment, and it's a result of an evolution over the last 12 months and even before. First of all, the financial markets in our country became very complex and very sophisticated in terms of the instruments that were being traded and being used in the marketplace. And this U.S. complexity was also transmitted internationally as the international markets developed along those lines as well. Along with this and supporting it was the substantial increase in consumer borrowing, where in this country we reached a level of the consumer borrowing 130% of its income, an enormously high figure, which was paralleled by a reduction in the savings of U.S. citizens that became negative as distinct from having some money in the bank. So we were very significantly extended. This negative savings rate combined with the overspending and the encouragement to really spend more than you had or could earn put us in this most difficult situation, which led first and foremost to the collapse of the two mortgage agencies, Freddie Mac and Fannie Mae, and thereafter the collapse of financial institutions, Bear Stearns and Lehman Brothers, and of course a huge challenge to a company that is known in your part of the world, AIG, which has also had support. And so this led, after a period of really 12 months, to a critical situation in which the government sought to intervene to calm the markets with the Emergency Economic Stabilization Act, in which the government indicated that it would put up $700 billion, and as you could see, other governments around the world came together at both head of state and finance minister level, and each country came forward with a financial program that would deal with the crisis, or attempted to deal with the crisis. In recent days, the program has been expanded or extended to $700 billion, so that banks have been supported with a program for $250 billion, $125 billion of which has gone to 9 banks in our marketplace. And this has received favorable comment, so much so that today at lunchtime, the Fed Chairman Bernanke was making a speech in New York describing the strength of the interventions and indicating that this was a forthright statement by the administration that would also be supported subsequently by interventions to make sure that the commercial paper market and other instruments would be supported. Well, the lunchtime speech left with it another comment of the chairman, which spoke of the economic activity being restored, and he said this will not happen right away. And I should add just one last thing, which is that this is all happening 3 weeks prior to our election, where there will be a change, or there will not be a change of leadership, depending on the result. This leads to a sense of uncertainty in our country, and I think the result was shown today. Of course, we're all hoping that things will modulate and we'll get used to it and that it will turn around, but as Chairman Bernanke said today, it probably will not happen right away.
Thank you, Mr. Wolfenson. Next, I'd like to ask Mr. Alexander, how do you diagnose the current crisis from an economist perspective?
This current crisis started with a housing bubble that had evolved in the United States in the early part of this decade. It reached its peak around the end of 2005, beginning of 2006, and as prices started to correct, it generated losses in for the core institutions of the financial system. Those losses in turn forced those institutions to retrench. So they reduced their new lending, they tried to shrink their balance sheets, and that had the effect of tightening financial conditions pretty much across the system. That meant higher risk premium, lower equity prices, higher mortgage rates, things like that. Now that tightening of financial conditions, which really began over a year ago, has had 2 sort of sets of effects. First of all, over the course of that year, as Jim Wolfenson indicated, it has revealed weaknesses in our financial system which I think were underappreciated. Our system was more dependent on liquidity and leverage than I think most of us had recognized. And that has meant that this adjustment has proven to be more difficult to correct and longer lasting than I think was originally expected. But in addition to that, it's feeding back materially onto the economy. Now, the U.S. economy was dealing with the correction in the housing for several years before the crisis really broke. But now we're sort of dealing with the consequences of these tighter financial conditions. And that we're seeing across the economy in a variety of ways. Clearly, the wealth of the household sector has been diminished materially, both because housing prices are falling and because equity prices are falling. You're also seeing credit being tightened. That's both for households and businesses, and that is affecting their spending. Most recently, in the last 4 weeks or so, with this extreme turmoil which has followed the failure of Lehman Brothers, we've also started to see a sharp loss in confidence and a sharp increase in risk aversion across the economy, which I think is leading to a very sharp slowdown. So we're facing, I think, a quite significant economic challenge. I would point out it's not just in the United States, it's also in the United Kingdom and Europe. In some respects, they are not as far along in this adjustment as is the United States, and therefore the correction there may in fact take longer to play out. And I think this is not a sort of correction which we should expect a quick rebound on. Moreover, as I'm sure your audience is aware, in the last several weeks we've started to see some meaningful spillovers in emerging markets. Obviously, currencies have been affected. You're starting to see strains on some financial institutions. So this is becoming a much more global crisis. Well, I think the policies that have been put in place over the last week are significant. and I think will go a long way towards putting us on the right track. But as Jim Wolfenson indicated, I don't think any of us should expect a quick turnaround.
Mr. Schaefer, do you have any additional comments on the diagnosis? Will the bailout plan by the U.S. authorities work to resolve the current financial crisis?
Okay, we want to move on to how do we get out of, and I think that's probably right, because Jim Wolfenson and Lou Alexander have given you a good picture of what has happened and how we got here. I would just want to emphasize something that Jim said, and this is not just a U.S. crisis anymore, and it's not just the spillover of what happened to the U.S., especially to Europe, that is a result of the problems there. You look back and many of the same conditions that we had in our market in America, you can find were there in Europe, and that's, although the problems are coming a little more slowly to the surface, they're there as well. And I think before you think about sort of how we get out, it's important maybe to step back from what Jim and Lou have said and identify three areas of failure that contributed to this. And one, in the U.S., were very serious failures of consumer protection. And business practices were allowed to go on unchecked by the authorities in the subprime mortgage market and the mortgage market more generally, where people were systematically being encouraged to take mortgages that were not appropriate for them, often encouraged to misstate data and so forth. But that in itself would not have created a major crisis if the buyers of the securities that were created with these mortgages had been doing their job. There were also major failures of risk management. And there were many elements to that. We don't have time to go through all of them, but there were failures of the loss of information from the desk where the mortgage was made to the portfolio where it finally wound up. There were failures of modeling, which ignored well-known features of securities prices, that they have more frequent extreme events than the modelers usually assumed. The correlations tend to change in times of stress. That they didn't deal adequately with complexity. There were major failures in the risk management area. And third, I think there was a failure to recognize, and I have to admit I didn't recognize this myself, the vulnerability of a modern financial system to a systemic loss of confidence and loss of liquidity. And that's the critical problem that we're dealing with now. I must say, as this was building up, I felt that there was nothing that could happen in the markets that the Fed couldn't respond to, with cuts in interest rates and provision of credit through the discount window. The Fed did that, and it hasn't solved the problem. The freezing up of money markets has gotten deeper and deeper. To get out, the first thing we have to do is to get the money markets working, then get the credit markets working, then get the economy moving ahead again. I think it's got to have that sequence. The focus last weekend at the IMF and World Bank meetings was in putting together a relatively global approach to dealing with getting the markets functioning again. And so you have seen, I think, a remarkable and appropriate response of the leaders of many countries to put new capital into banks, to provide additional and new liquidity mechanisms, and to guarantee deposits and other instruments of banks. I think that is the right response. It's a response that shocks many of us that we had to get to the point where we took it. It is the way to get things started. It's discouraging but not surprising that the markets have moved up one day and down the next. It's going to take time to build confidence in what's been put in place. I think the right thing is to continue down this road. The governments have to demonstrate to the markets that they are fully implementing on a rapid basis what they have committed to. And with that, one will begin gradually to see more confidence.
Thank you. Professor Logov, you are not just a professor in the academia. You have experiences at the IMF and the Federal Reserve System. So we want to hear your diagnosis on the current financial crisis. And also, we'd like to hear your insights on the impact of the current crisis on the global economy.
I think I would pick up on a point that Mr. Schaefer said moments ago, that we built up this elaborate financial edifice with all sorts of rocket science ideas like options and securitization and lots of fancy innovations, and yet, at the end of the day, it has proven as vulnerable to good old-fashioned bank runs as our system was in the 1930s, and that's what we're experiencing. Jeff Schaefer described it as a systemic loss of confidence and a loss of liquidity. That's, of course, exactly what a bank run is. I think there are some elements to what we're seeing having to do with the fact that this financial edifice had grown too big, that it needed to shrink. There were a lot of warning lights blinking. And I think it's important to underscore that during all this period, the American authorities were essentially in denial. If you listen to Alan Greenspan as chairman of the Federal Reserve, listen to a sequence of Treasury secretaries, we were told that this was all because the United States was a great economy, everyone wanted to invest here, we had the most dynamic financial system. But you know, when you speak to people, leaders in emerging markets or other countries before they have a financial crisis, it's a very similar tune, that money's rushing to us because we're so great. We're seeing asset prices, maybe stocks, maybe housing go up because things are so great. The indebtedness is nothing to worry about because our economy is growing so fast, and yet the problems happen again and again. And indeed, another characteristic of the U.S. economy that's so parallel to others is this denial. And the denial is more dangerous than the problem itself. When a country's leaders recognize they have problems, it's usually very possible to deal with them. But when you deny that there's any problem, then you're not looking, you're not alert, and I think that's what happened. I would also say in the management of the crisis over the past year, the U.S. authorities have, by and large, always done the right thing, but until recently, at least, too late. It's been too little, too late, as imaginative as they've been. And I think some of the problem comes within the political realm of this denial, that everything's fine, we don't need to do that much, we'll just have some interest rate cuts, take some aspirin, call the doctor in the morning, this nightmare will go away. I hope that that denial's passed. And if I can make one final point, I think it's important that American authorities talk to leaders from emerging markets who've experienced crises like these. I think had they done that at an earlier stage, they would have gotten the advice that you have to get ahead of the crisis. You can't always be a day late and a dollar short with your policies. Anyway, thank you.
Now let's get to the crisis resolution part. Mr. Wolfenson?
Clearly, what needs to be done is to try and give the consumer in this country a sense of confidence that he can go out and start spending again, but doing so in a climate also where hopefully he will also start saving again. There is a need in this country to build some stability into the system, as well as getting the engine functioning again. And those two things, of course, are opposite, but I think we should not forget that the solution is not just a spending spree. We need to go back, in our country at least, to some fundamentals and try and get saving reestablished as a worthy activity, as well as appropriate spending as the consumer becomes more confident. We have a difficult task to do because the Federal Reserve and the Treasury have done a great deal to assure that liquidity is put back into the system and that we can get the instruments of borrowing and the instruments of commerce reestablished with liquidity. But we still have to get through the question of the quality of assets of these institutions. We have to run through the overhanging debt and the resolution of that debt by cleaning it out and starting again with a base that can allow us in this country to again be a leader both in bank stability, bank quality, and in economic activity. This will not happen right away, but what I am pleased about is that it appears that both parties, both the Democrats and the Republicans, realize that this is a composite program which needs to be put together, and it would be very surprising to me if within days of whoever is elected, the first thing on the agenda is not addressing this economic crisis with whatever team can be put together, and hopefully giving some leadership and a restoration of confidence which will be essential for the economy to start again.
Thank you, Mr. Wolfenson. Professor Rogoff.
As Louis Alexander said, we already have Europe in recession, probably Japan. I believe the U.S. is in recession. Emerging markets will feel it. However, had the United States not intervened in this way a couple days ago, we were really looking at an abyss. It was an extremely dangerous situation. All confidence had been lost. If you look actually even some emerging markets like Mexico, Argentina, Turkey, the spreads on their government debt were starting to trade at near default levels. There was tremendous fear going on in the market. And the U.S. authorities stepped in finally, and it wasn't simply the billions of dollars they're putting in, but they guaranteed bank debt. That was really the big problem with the credit markets. They expanded deposit insurance in some dimensions, unlimited amount. These were very important steps. Now, the Americans really were following the leadership of the Europeans. The Europeans figured this out first, and once the Europeans had backed their banks, we really had very little choice, or all our money would have flown and gone out to Europe. This was a good step, but it really just prevented the hemorrhaging that was going on. We've been talking about a financial crisis since August of last year, but the last month, that was a financial crisis. It was really gone to a whole different level. I think that the worst has stopped, but that doesn't mean that there aren't still very difficult times ahead. There are many, many difficult decisions. How to recreate the financial system. Will we have universal banks, as the example of Citibank? Will we have a more diverse structure? What will be done? I think it's very unclear. How will we deal with the American consumer who hasn't been saving in a decade and has a savings rate of effectively zero, which Jim Wolfenson talked about? What's going to happen now that they see their housing prices fall and equity prices fall? They're not going to keep consuming at the same rate. There's some very, very difficult challenges ahead. But if they hadn't done this bailout plan, we really would be looking at the Great Depression again.
Thank you so much. Mr. Alexander, since the collapse of major investment banks, there has been a lot of criticism on the U.S. Financial system. Will we see another system?
I think there's no question that one of the things we've learned in the last year is that the way the U.S. system had evolved, and I think in many ways it reflects the core of the global financial system. This wasn't just a U.S. problem. Has many weaknesses that need to change. One of the first points I'd like to make in this context is market discipline is doing a lot of that already. Many of the worst practices that led to this crisis have already stopped. For example, the issuance of so-called structured credit products, some of the very complex financial instruments that were at the core of this, has essentially gone to zero. And so to some extent there is a process of market discipline in place which is driving the transformation. You mentioned the fact that the standalone investment banks have, in many respects, left the scene in a major way. That is another example of market discipline sort of working its way through. I think there's no question that we're going to move to a system which is less reliant on leverage, and we're going to go to a system that in some sense has more robust financial institutions, more diverse financial institutions. And I do think that means the universal bank model is the one that I think is in some ways is going to come through this the best. Now, I want to add, though, that it's not just the structure of the institutions that matters. One of the things we've learned is that some of the infrastructure and the way financial securities markets work have proven to be very vulnerable. And I think there are going to be important changes there as well. For example, we're going to see greater uses of exchanges. We're going to see greater uses of central clearing counterparties in the derivatives market. These are kind of technical things, but they will, I think, have the potential to make the system more robust, and they are going to be very important changes. And of course, we're going to have more and different sorts of regulation. Higher capital standards. I think there's going to be a greater focus on trying to make the system less pro-cyclical in the way it takes on risk. All of that is going to be a major challenge to the regulatory agencies. And just let me end on 2 points about that from an international context. First of all, if we don't do this in a coordinated way globally, it's not going to work. So this is going to be a real challenge for global cooperation to find a system which works globally. The second point I would make is, in many respects, I think this is an opportunity for emerging markets, in the sense that the changes you're going to see at the core of the system can provide a model for how emerging economies can have their financial systems developed in hopefully a more robust way than the path that we have been on before.
Thank you, Mr. Alexander. As Mr. Ulfunsen pointed out, we are lucky today to have Mr. Schaefer here with us, who was Assistant Secretary and subsequently Undersecretary for the U.S. Treasury. So I'd like to seek Mr. Schaefer's wisdom to improve risk management. Strengthening regulation is one of the key issues being discussed these days. Mr. Schaefer, what do you think is the ideal policy concerning regulation? Should we increase regulation or should we decrease regulation at this time?
I don't think it's a question of increasing or decreasing. It's a question of changing it. Clearly, we need another kind of regulation than we have had up until now. There are some areas I think we have to take much more seriously than we have, and I mentioned my earlier comments, the area of consumer protection. I think that the risk management needs to be looked at in all of the core financial institutions in a coherent way. And I think there's also a need for a more alert, attentive, systemic oversight to have a sense of what's going on in the system as a whole, so that these things don't build up to the extent that they have without their coming to people's attention. And interestingly enough, under Secretary Paulson's leadership in the Treasury, before this crisis really got started, he had started a process of rethinking the regulatory structure for the U.S., where he identified those as the 3 areas in which you ought to reorganize the regulatory structure. And I do think that's an appropriate thing to do. I'm a little skeptical that we will ever get there in the U.S. We have a political process that tends to give weight to vested interests and special interests, and I have watched many rounds of trying to rationalize regulation in the U.S., and they have usually led to greater complexity rather than less. One can hope that this shock was big enough that it may bring about some of the more fundamental changes we need. I think there's a parallel need to have a systemic approach to regulation within the euro area. The supervision regulation structure in the euro area has still been too fragmented among the member states, and they need to bring it together. I'm less enthusiastic about the idea of having a grand global system. It is national governments and entities like the EU and the euro area that are responsible to voters and that are responsible for budgets, and I think we will continue to live in a system where it is national governments who operate. But we can certainly reinforce the collaboration across countries so that we have a common approach, even if it's carried out independently in different countries. And in fact, the capacity to do that was in fact demonstrated last weekend when we saw many different countries enacting in their own way the common principles that they had worked out together. So that's what I look forward to. But coming back to the specific risk area, I think it's going to be important to redefine the role of the state and the role of private firms, whether financial services firms or others in our economy. We have come, I think, and last weekend marked a punctuation point in history where for 30 years or more, the world had been trending towards freer markets and more scope for markets. And suddenly you've got the icon of the American capitalist system, Goldman Sachs, accepting government share ownership imposed on them by the former CEO of Goldman Sachs. And I think that is a fundamental change. And I hope it doesn't start momentum in the wrong direction. And I have an analogy that I use that it's usually applied to soccer, but in tribute to the Korean gold medal winning baseball team, I will say it in terms of baseball today. I think it's very important to recognize that government is not equipped to be the manager of the baseball team, let alone being the players on the team. They cannot tell them how to swing the bat, how to catch the ball in detail. But we need an umpire on the field to enforce the rules and to make the calls and to make sure everybody plays by the rules. And that is the role of the government, to develop those rules and to impose them fairly and efficiently. And I hope that as we move forward into finding a new structure, we have stronger umpires with new rules that are more appropriate to the new system, but that the state does not think that it should take over the role of private decision makers and try to run the system.
Thank you. Each one of you has 1 minute to make final remarks for the audience.
There are many Koreans who have been working in Wall Street on the investment banking side, not alone in the securities aspects, but also on the advisory business. And I think the development of your professional competence and the professional cadre of people in the financial sector would be a very useful thing to see develop within the context of Korea, not just in relation to Korea, but as a stepping stone to an emerging Asia. And it would be, in my judgment, a very good growth opportunity to have professional institutions, Korean staff that would be looking at the possibility of the professional advisory business and the fundraising business that could be centered in Korea.
Thank you. Mr. Alexander?
I think when Jeff and I were working in Washington in the late 90s, there was this sort of view of globalization that would sort of imply a convergence of financial systems as being part of that process. I look at the way the world is evolving today with the growing importance of China and places like Russia and the problems we're seeing in the sort of the core of a global financial system, and it seems much less obvious to me that that's the process we're going to be living with. And I think one of the challenges we're all going to have to deal with as we sort of come out of the other side of this is how do we, in some sense, promote globalization and global integration, which has been a very powerful force, in a world where there are going to be kind of different approaches to these things. And that's going to be, I think, one of the big challenges we're all going to have to face.
Thank you, Professor Logo.
Well, I think a lot depends on which direction the United States decides to go. We're going to have a new Congress, a new administration soon, and it's certainly a possibility that the political winds here will choose not to try to rebuild the system and to put so much regulation on that investment banking will not come back here for a long time. But yet there have been many innovations, many business ideas, many really tremendously successful innovations. And if the United States chooses not to resume the leadership in this area, it's an open field. It's not an easy one to take, but I wouldn't be surprised to see Asia getting a piece of it.
Thank you, Mr. Schaefer.
Let me go back to where this discussion begun, which is where are we today? And just to reinforce the fact that we are in the middle of what is, for people in financial markets, the scariest time since the 1930s in the US and much of the rest of the world. That is real. I do think we have the policies in place that will see us out of it, but it's not going to happen overnight, and it's not going to happen in a straight line. And so we will have to become accustomed to living with a great deal of uncertainty at the same time. I think Asia is not unaffected by this, but you here in Korea and in China and other countries in the region have your own strength, your own capacity to generate demand, and I think one needs to carry on and watch what's happening in the U.S. and watch what's happening in Europe, but not be paralyzed by it and continue to pursue your future here.
I'd like to thank world-famous distinguished panel members, Mr. Ulfenson, Mr. Alexander, Professor Logov, Mr. Schaefer. Thank you all.